Is the latest inflation data released this week good news or bad news for the stock market? That's the subject of this week's Fastest 4 Minutes in Finance. Hello, I'm Scott Inman. April inflation data was released this week, and it was pretty much in line with expectations. The Consumer Price Index was up 0.4% in April compared to March, and year over year, prices rose 4.9%. That's the lowest annual inflation rate we've seen in 2 years, which is about the time inflation began to run hot. Core CPI, which takes out food and gas prices, was up 5.5% year over year and also up 0.4% from the previous month. Now, under the hood of the overall inflation number, we find that rent prices continue to climb. The index for rent rose 0.6% last month, and the shelter index was up 8.1% year over year. Those increases accounted for about 60% of the total increase in core inflation. Energy prices were down 5.1%, but food was up 7.7% compared to last April. But at the same time, food at home continued its month-to-month trend of declines. So really, the inflation report seems to be all over the map. The market responded with confusion. The S&P 500 and the Dow Jones started the day in the green, but turned red as the trading day went on. Investors want clarity on the timeline of when we will tame inflation and when the Fed will decide enough is enough on raising interest rates. And quite frankly, we are just not getting that clarity. There is still a good chance that the rate hikes are over. Language from the Fed's last meeting suggested they might take a pause on raising interest rates, but the likelihood of cutting rates anytime this year seems to be very low. Inflation is trending down, but prices are still rising at above historical rates. So the argument could be made that we as investors and consumers should be prepared for higher rates and higher than normal inflation for a longer period of time. So what should we do about that? Well, we have to understand the environment. For instance, interest rates on fixed investments like CDs look more appealing than they have in decades. But if prices are rising at about the same rate as interest rates, which they are, you're not really outpacing inflation. The place for CDs and money market funds is for your short-term money. If you need to spend it in the next year, these investments might be ideal. But if you're preparing for a longer-term future like retirement or trying to reach true financial independence, you cannot be afraid of what happens in the stock market during the next year. Stocks will continue to be volatile until clarity is reached on the economy. But historically, stocks are one of only 2 asset classes that have outpaced inflation. The long-term rate of return of the S&P 500 is around 9%. The average inflation rate is 3.8% since 1960. Bottom line, the jury is still out on how long it will take the Fed to tame inflation, but it should not affect your plan to beat it. Thanks for watching.